Hello, you're watching Fund in Focus. I'm Sarah Allen and today I'm joined by Mike O'Neill. We're going to be discussing the IML Equity Income Fund. Mike, welcome.
Thank you for having me.
To begin with, can you give me an overview of the fund?
Well, the fund is designed to pay a quarterly distribution at least 2% above the ASX 300 index yield. And that's after fees and before franking. So the way we achieve that high yield and do it so consistently is by generating it through a diversity of sources. The core is a portfolio of quality value stocks that generate high and in many cases growing dividends. But we can add to this additional income through really simple option strategies. So we add on the top of our 4% or thereabouts dividend yield about 2% from options. There are some realised capital gains, but we try and keep this modest because we like to see a growing unit price in the fund. And what's really important to us is that this fund has consistently delivered on higher income over the period since its inception in 2011 and done so with lower volatility and lower drawdowns than the overall market.
What's the outlook for dividends in Australia? Are you expecting any more cutting activity?
On the whole, I would say flat. So if you look at the lion's share of the dividends for the Australian index, which come from resources and banks, in the case of resources, BHP has stepped away from its progressive dividend policy because of the volatility we've seen in iron ore prices. The banks at the moment, their dividends are being supported at high levels by benign conditions. Doesn't look like the economy is going to struggle or will have a bad debt cycle anytime soon because job vacancies are still quite high, but it's something to be mindful of. But we really try and be selective because there's plenty of dividend traps out there. There's companies that are paying unsustainably high dividends, not supported by the cash flows. They might have refinancing for their debt coming up on higher interest rates. They might have cyclical or discretionary earnings. Through the reporting season, I don't know that we spoke to any company that wasn't worried about persistent wage inflation, structurally higher energy costs. So it's a point now where if you're looking at your disposable income, it's under strain for most people. So the idea that you can keep pushing price is being challenged. So where we look for opportunities is those companies that have invested over time to maintain a market leading position, to justify the pricing power they have with the consumers. And there's plenty of those examples if you do your bottom up research. Stocks like Sonic Healthcare or Steadfast or Suncorp, they don't all start with S. Orica's another example, but those are the sort of companies that you can rely on the dividends in doing the heavy lifting for you.
The fund has a focus on income. Why are investors increasingly looking towards equities as part of their income strategy?
It's a good question and it's very timely, I think. Dividends are always important, don't get me wrong. If you look over the last 20 years, I think of the ASX 200 total return, they were roughly half. So they're always important, but right now, I think the conundrum people face is the uncertainty of inflation. So term deposits and cash are yielding higher than they were, but is it enough for you to keep pace with inflation in terms of your real returns? So equities would seem like a necessary evil at the moment. But if you're going to invest in equities for income, you need to do it prudently. And part of that is looking for a diversity of sources to help you generate the consistency of income through time. Do so with being mindful of the volatility of your capital, because you don't want to put yourself in a position where you have to draw down capital at an inopportune time in markets.
The fund's been able to deliver consistent dividends for the past 4 years. What criteria do you look for in stocks to ensure this?
We start by looking at quality and value. Our mantra is looking for companies with recurring earnings, capable management, some growth, and getting them at the right price. But what it really means is finding those stocks that can compound their earnings over time and have growing dividend streams. And it's as much about getting stocks with upside and steady dividends as it is about the downside. I think we actually spend a disproportionate amount of our time worrying about downside risk. So a good income stock for us is one with a high yield that's quite resilient to the economic cycle. Two standout examples are Charter Hall Retail REIT, CQR, and Horizon AZJ, both of which should do very well regardless of the market and the economic conditions we see ourselves in.
The fund has an allocation of 20.1% to cash, but it can go as high as 50%. What would lead you to increase or decrease that allocation?
When we say 20% cash, it's important we're not talking about physical cash holdings. So in this fund, physical cash holdings should normally be around 5%. We want to stay fully invested. We want the vast majority of the funds that we manage to be in good dividend paying stocks. That's what underpins the yields that we generate. So the 20% accounts for the effective exposure of options. So if you own a stock, you buy it at a good price, it goes up, you write a call option. If it keeps going up, your effective exposure to that stock goes down because the probability of that option being exercised such that you sell the stock goes up. So your effective cash goes up. If you think about that as a portfolio level, we never have to cover more than, say, 1 in 3 stocks with options, or a third of our portfolio, in order to generate to our income. We're never covering 50% or so. We're never in a situation where we're underinvested in a rising market. But the main reason the cash would move is if we saw a strong rally in the markets such that those call options went further into the money and our exposure to the stocks on an effective basis went down. The parameters otherwise stay pretty stable for the fund.
So you brought up options trading then. How are you using these strategies within the portfolio?
Probably easiest to explain first what we're not doing before we say what we are, because options can be a dirty word to some people. So what we're not doing is we're not systematically stripping income. We're not using high frequency quantitative strategies to take income through options. We're not using them to gear or short our portfolio. So what that means is if the market moves around, we won't find ourselves forced buyers or sellers of a lot of the stocks just because the market's been volatile. What we do is very vanilla. It's tied to our quality and value fundamental approach. It's bottom up. If we own a stock, we like it at a certain price, it hits our price target, we'd otherwise be selling it to reduce exposure. If you write a call option, you can take the promise of future capital appreciation up front in the form of income, but you've got to be prepared to lose the stock if it goes through that strike. You'd otherwise be trimming the position anyway because it's gone beyond what you want to hold it at. Where we don't cover stocks with call options is where we have a high conviction idea, where we want to retain the entire upside. So in aggregate, we get about a third coverage, but really the high conviction positions would never have any coverage on them. I guess the key though is with options, you can use volatility in your favour. When markets are more volatile, your income generation can be higher. If dividends are uncertain, that could be a natural offset, and it certainly proved to be that for our fund in times when dividends were challenged.
The fund's underweight to materials and financials. Why is this?
When we look at our Australian index, and today materials plus financials is over a half of the index, we don't consider that a natural default position for an investor who's relying on income from shares to fund their lifestyle. We see consistent income opportunities elsewhere without having to take that level of concentration. Ultimately, when you've got a commodity stock, the commodity stock share price follows the underlying commodity price with a pretty decent correlation. So when the price is correct, when the supply and demand imbalance corrects, and long-term prices reassert themselves, not only is your dividend cut, but your capital is at risk. I think a lot of investors got caught with this with lithium stocks last year. So equally, iron ore stocks are a risk. We own some BHP as the highest quality name, but certainly nowhere near the exposure of the index. Now, banks are an interesting one too. Although we own major banks, we don't hug the index and own 20% major banks. Where we put our capital to work in the financials is more in the insurance companies. So Medibank Private, Steadfast, Suncorp, which we believe have stronger margin prospects and a little bit more defensive earnings and dividends.
What kind of investor do you think the fund suits best?
From personal experience, my parents. So the day that I got my parents into our fund was the day that I received fewer calls on what's the market doing today or what's happening with my dividends, because things were smoother, more predictable, and it suits that investor who wants that security of a stable income stream, although higher than you can get from the so-called very low risk classes like your term deposits and cash. It's considerably higher, and it's steady, paid quarterly. So if you're looking to rely on income to fund your retirement or as you approach retirement, this would suit. So right now, I think with that uncertainty of inflation, this is key because those classes aren't earning sufficient real returns to get you there. A lot of people are worried about how much they need in terms of a capital balance to rely on in retirement. So if you fit that bill, I think this product makes sense. Where it would not make sense is if you were looking for speculative participation in market gains, because we won't keep pace if the market is running strong, and if we're in a strong sort of double-digit rally. We're playing more that role of the steady, reliable income and the lower drawdowns for retirees.
Thank you for taking us through the fund today.
Thank you.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.